Meanwhile, Buffett was making that first million. But this was early in his career, and he was still finding his way. So it wasn't the Coca-Colas he was after. He'd looked to invest in obscure companies, using Moody's manual. Moody's was a directory of financial data of thousands of companies, the kind of thing you can get with a click of a mouse these days. And the young Mr. Buffett would scrutinize it on the search for bargains. He was looking for undervalued companies, the ones when you looked at the total value of the shares, they were somehow worth less than the assets of the company. These were called cigar butts. Why? Because you could pick them up for almost nothing, but there was still a little bit of value left inside.
So a lot of stocks are cheap for a reason, and often a value investor will figure out the reason because everybody else has gotten sick of a management raping and pillaging a company, overpaying themselves, deploying capital poorly, taking advantage of the shareholders with free stock or huge options awards, or hiring their brother-in-law. So there are stocks that have been perennially undervalued because they're run by somebody who fits that profile. A novice value investor will come along and say, well, that looks awfully cheap. And Graham and Dodd didn't really place the quality of management as high as they might have. And so good managements add value. Good managements have lots of levers they can pull. They can buy back stock when it's undervalued. They can use the stock as currency when it's overvalued. Bad managements will think only about themselves first. And so those are early lessons, but profound lessons that I learned them well.
Third point is we always prefer stocks that are in the news because we have quick access to them and therefore can believe the story one way or another. This is not a good reason to buy a stock. Research has been done by 2 finance professors at the University of California. They found that as long as there are attention-grabbing events of any kind, whether positive or negative, investors are more likely to buy these stocks than sell them. The moral of this story is buy stocks that nobody's ever heard of and that no analysts cover, not ones that are always in the news. As you can tell by this chart of research in motion, it's very difficult to decide when to buy it and when to sell it because the stock is moving every day based on whatever the recent news is. Don't let that cause you to make a mistake.
Well, you mentioned that stock list of 19 names that you saw, and I'll give you an idea of what they have in common. First of all, they have phenomenal balance sheets. Most of those companies, once again, have net cash in their balance sheets, and as a collection, those 19 names, on average, can get rid of their debt with 20% of 1 year's cash flow. They yield 3.6% on average, which is 160 basis points higher than the 10-year Treasury. And to give you a sense of how cheap that is, if you just assume that those 19 names grew their dividends by the same rate over the next 10 years as they did over the last 10 years, and then you said, okay, well, how much would those stocks have to fall in order for me to get the same return on the 10-year, on those 19 stocks as the 10-year Treasury? Those stocks would have to fall 40%. Because the 10-year Treasury yields 2%, and these stocks yield 3.6%, and some of them, like Johnson & Johnson that you mentioned, have been growing their dividends for the last 20 years at almost 14%. So as a collection, these stocks offer much better yield than you're going to find anywhere else in the world. These businesses are doing much better than most people anticipated because a large portion of their business is actually outside the United States. So although the U.S. economy is only growing 2 to 3% at the most, these businesses are growing their revenues 6 and 7%, and they're growing their earnings higher than that. And they're doing that because a good bulk of their business is overseas, and the overseas markets are growing much faster. And I'd say that it's very easy to find companies that have grown the dividends consistently for 20 years, that are selling at 9 or 10 times earnings, with 7 or 8% free cash flow yields, with net cash on their balance sheets, that have the ability to grow their business, the same way they've done. And in many cases, even if you looked at the past 10 years, which was a very difficult period, we've had 2 of the worst recessions in history, and a lot of these firms have done incredibly well over that time period. So it's not inappropriate to think they'll do equally as well over the next 10 years. So I just think people are spending so much time thinking about overall risk, about sovereign risk as opposed to company-specific risk, and they're making these asset allocation decisions that's a risk-on, risk-off trade that totally ignores company-specific valuations. And it's providing opportunities in my view that are consistent with the early 19...
Well, people typically go to whatever has performed well, and about the only thing that's performed well recently are precious metals and gold in particular. And gold can be a wonderful investment as a diversifier, but it is volatile as heck. Generally speaking, it only keeps up with inflation, and to get into their gold because it's doing real well right now, it's not the ticket. And I've made that mistake before, by the way, when I graduated college and thought I knew everything.
You invested in gold, is it?
I bought gold at $664 an ounce in 1979. That has not come close to keeping up to inflation, and I would argue it's the best investment I ever made because it taught me I wasn't as smart as I thought I was.
Don't you just love headlines like this? It's great for selling newspapers, but it's terrible for getting people to get in a panic and wanting to sell. Remember, you don't lose money until you actually sell a stock. Rather than see this as a reason to panic, let's use this as an opportunity to buy good stocks at cheap prices, so that if we do come out of this market turmoil, or if we go into recession when we do come out and the economy strengthens again, you'll have more shares with greater dividend income and therefore a better opportunity to make big returns on the upside. The way to do that in this market is not to buy at the market. Do your homework first and get an idea of what you think is a really cheap price for an individual stock. And then you do that by using limit orders. Limit orders are basically just an order in the market to buy a stock at a certain price. And what you want to do is make it really, really cheap price, or a stupid price, such that if a stock's trading at $20 today and you put in a limit order at 10, it may sound unreasonable, but you never know what could happen if a gap trade occurs, if we get capitulation in the market. This hasn't happened for 6 years, so here's where opportunity is striking, and we have to be able to strike while the iron is hot. For example, back in 2001, nobody wanted to own Carnival Cruise Lines because of the terrorist attacks for fear that somebody was going to sink a ship. The stock closed on the Dow Jones at $24, and when the market reopened again, we had a limit order in at $17 a share, much, much lower than what it had closed at previously. When the markets reopened, by 10:30 that morning, and for